Good afternoon, everybody. It's a pleasure to be here with Mark today to talk about corporate governance metrics and investment analysis. I'm Katie Beith. I'm the head of ESG at Forsyth Barr. I call myself an ESG professional. ESG stands for environmental, social and governance, governance being corporate governance. And my job is to look at those sorts of issues and how a company is managing them and changing going forward to ensure they're managing risks, taking advantages of opportunities and positioning themselves for a more sustainable future.
Hi, welcome to Governance Bites. My name is Mark Banicevich, and again I have the pleasure of spending time with Katie Beith. Katie, thank you very much again for your time. I really appreciate it. I love the expertise that you've got in environmental, social and governance through an extensive career in this space, both here in the UK and Australia. So a great person to speak to on this topic. I'm stepping back a little bit this time from the narrow subject of ESG into how investment analysts make decisions, investment decisions around companies, particularly around governance. And Forsyth Barr's been a company that's been around for a very long time. It has used or evaluated governance in its investing decisions for a long time. What are the most common metrics that investment analysts use to understand the qualities of a company's corporate governance? What do I look at?
I'll just start with to say that there's a lot of things that go into making a financial decision and to making a decision to buy, hold or sell a company. Corporate governance is just one of very many things to look at, whether the quality of a company's strategy, how well it's functioning, its results, its debt levels, its
position in the market.
Exactly. There's so many things that go into real analysis of a company, and corporate governance is another kind of lens to look through and another piece of information to collect in the jigsaw puzzle. Commonly, the sorts of things that traditionally have been looked at is how a board is set up, what's the composition of the board, has the board got enough independent directors on there to challenge appropriate decisions. What about the relationships with auditors, and how long has that auditor been a relationship? Things like protection of shareholder values, things like if a company capital raises, are they doing it in a way that's appropriate to all shareholders? There's really a lot of things in the corporate governance arena, and it's sort of as long as a piece of string, really.
Well, where do the investment analysts source the data for these metrics?
There's lots of data available in annual reports now. There's always corporate governance, especially of the big, large listed ones. And there's requirements as well. So you've got the NZX code, you've got the FMA handbook, driving good corporate governance. You've also got the New Zealand Corporate Governance Forum and their best practices. So there's plenty of
the standards
tools
that they've got to be held to.
That's right. Yeah, it's clearly defined.
So a lot of the data then is sourced from the annual reports. Annual
reports, yes. That's where we find a lot of data these days, and particularly around corporate governance setups of companies.
Right, and as is common, I guess, in most countries, the listed companies have probably got more information available than the unlisted companies. Right. Is a governance quality better measured through quantitative data or through qualitative assessments?
A mix of both, I would say. Quantitative data gives you some of the story, but not all. And the contextual information around that quantitative data is just as important as the actual data itself. And then I think, more and more, sort of particularly with the research we've done recently on how New Zealand companies are governed, it was really interesting working with the analysts about how much they pick up on signals in the boardroom, like body language or eye contact. I know those sorts of things are all add to how you might think the corporate governance of an organisation is functioning, and whether it's functional and going well. So
right,
there's a lot
sort of qualitative measures around the culture, around the boardroom.
all sorts of things.
Yeah, wow. And I'd love to actually talk to you a little bit more another time if we can around the research as well, because that was very interesting. What is the strongest evidence you've seen that good governance drives better financial performance or financial returns?
There is quite a lot of research around about that. I think like where I sort of end up putting my time is really when things blow up and looking at what went wrong, and sometimes it's fundamental corporate governance problems that may well have been the cause, whether it's I'm talking about some of those big US blow-ups back in the early 2000s, the Enrons and the Tyco, the Palm-Ladder European company, and often there's some relationships on the boards, or things have been hidden, and and then you have a look at what went wrong and why, and you can generally unpack and pin it down to some.
Quite often in those,
yes, that's right, or changes in accounting practices, or all sorts of things that kind of give you signals that
so
things went right.
in your experience, you're getting more the other way, that bad performance is sometimes driven from poor governance practices.
That's right, and I mean, how do you measure risk mitigation? In a way, like it's how do you keep, how do you measure a risk that's been avoided? It's a really difficult thing to do. So when things are going well for companies, and we're really comfortable with their governance arrangements and setups, and the strategy, and their doing what they say they're doing, and their numbers are coming in line with what they predict and expected, and when there's nothing kind of hidden or uncertain, that's a great place to be. I think it's when disappointments come out, or unexpected things that we weren't ready for, or feel we should have had an indication of and didn't. Those are that's when we go digging and try to understand what's wrong.
I understand that. When I work with businesses, or when I'm talking to audiences about this stuff, quite often I'll say that when things are going well, companies don't tend to fail. Companies tend to fail when something comes and blindsides them, and they're not prepared for it. They're not good at managing or identifying or mitigating that risk. Yeah,
or being able to change when they need to, or adapt, or
absolutely. Which governance red flags are most predictive of poor performance or higher risk? You mentioned before the idea of independence on a board. What are the sorts of things that you would see in the data and say, that's something we should be careful of?
Because there are so many governance indicators that you kind of collect and that make up a general well-performing board, it's not necessary, and there's also, and it's not always, there's not necessarily one
no
or two things.
Method,
no,
right?
It's more like a culmination of things, but also, and particularly in New Zealand, when we're a small market with a limited pool of directors, it's not always the case that good corporate governance equals strong performance either. So there's always exceptions to that rule. So this is when the contextual and the qualitative side becomes really important. If a company is not operating at corporate governance best practice, do we understand why, and are we comfortable with those reasons, and do we have confidence that those reasons are fundamentally there and driving the company forward?
Right. How much weight should be given to board composition factors like independence, diversity, tenure, size of the board?
Yeah, I sort of see it like they're all important. Okay, and I sort of see it as a hygiene mechanism. The rules are there, and the good guidance practice is there for a reason.
Yes.
And it's built on strong research and analysis and history over time, to get to where we are. It's there and it's important. I see it more as a hygiene factor. It's just how companies should be operating.
It's the minimum standard.
Yeah, that's right. It is. Yeah.
Well, some quick fire questions for you then. Optimum size of a board?
Oh gosh, between 6 and 8. It will depend. Yeah, 6 and 8.
And it will depend on the case to case. So 6 to 8. And independence. What portion of the board would you expect to be independent?
Majority.
The majority of the board independent. What do we mean by diversity, and what would you expect to see?
Diversity is a really interesting one, especially right now. There's a lot of politicisation around the use of the term. For me, it's really about diversity of thought on a board, and is there enough independence around the table to challenge those decisions? Is there enough knowledge around the table, particularly, especially important in really scientific or technical areas? Is there enough independent knowledge around that table to challenge the direction of travel? Because boards can often operate with one or two very strong characters, and how do you navigate those dynamics around the board table, or the management of potentially a strong CEO, maybe a founder CEO even, and challenge them with enough information and the right skill set to make sure the strategy is right, to make sure the risks are well understood and are being managed, and that direction of travel is clear.
Yeah, so it's a very difficult one to measure with data, isn't it? Because we tend to look at proxies. The most common proxy is gender, and then ethnic backgrounds, the professional background, these sorts of things can be looked at as well. But again, there's still proxies for how diverse the thought is.
I think it's really interesting conversation right now, because it's quite common practice for boards to put a skills matrix in their annual report, which ticks the sorts of skills we're at. But I think corporate governance needs to evolve is, that's great that that's there, we can look at it, but it doesn't actually tell us how long ago that director got that piece of knowledge or education.
What's the depth of that capability?
That's right, and have they kept it refreshed over the years? Are they in their 60s, and are they referring to a degree they got 40 years ago? Has it been kept fresh and up to date? And the other piece is looking ahead. And there's a huge amount of uncertainty on the horizon, and more and more and more things that companies need to manage, whether it's climate disclosures, whether it's AI, whatever it might be. How are boards ensuring that they have the right people at the table to look at those major future trends that can be a real disruption to business? Yeah,
absolutely. The last quick fire question: tenure.
There's again, it's well defined, and again, it's a hard one, because although there's good practice standards, sometimes take Warren Buffett, right? you want him at the table and leading that organisation, and there's other examples in New Zealand like that. So I think when tenures get stretched too long, and what you really want to know is succession. Like how is the business planning? Should something sudden or untoward happen, and is there the depth in the organisation that you aren't so reliant on this kind of key person?
Right. Do current disclosures give investors enough insight into governance quality?
There's a lot of information. I think what a challenge is actually finding the time to decipher it. It is finding that, and then if it all looks pretty good, which it often does, when you interact, because shareholders often interacting with its large institutional shareholders, always interacting with company management. Are we getting the signals from the companies to back up that good corporate governance is in practice, or are there signals that are worrying us a little bit or niggling away at us? And then if you get that sense, finding the time to dig in and explore and unpack what it is that you think might be going on, and then being able to sort of talk to the company about it over time. So there's no one solution here or one fix it. It's very much a living, breathing, evolving, situation.
Pay the experts for their help. Which governance metrics do you expect will become more important over the next 5 years?
there's one issue that I have been writing about for a few years, which is around auditor tenure. New Zealand's a really interesting place in that there are a lot of companies that have very long relationships with auditors, like well over 10 years. So the good practice is that, and companies should review in New Zealand, define good practice, that companies should review their auditor at the 10-year mark. And if they decide to keep it, it's fine, but you should do a big, thorough review. Whereas the view that I've taken in some of my research is that actually the auditor should be changed at the 10-year mark because the independence of the auditor can be compromised over that time. And although lead auditor partners need to change every 5 years, that knowledge stays within an auditing organisation. So I think this is a really interesting thing in New Zealand. Last year we looked at 61 companies and 32 of them had auditor relationships over 10 years. Yeah, and
half of the companies.
And it's an interesting one because the pushback I get is New Zealand is small, we don't have enough auditors, the cost is expensive. There's all sorts of things that kind of will stop a company changing its auditor. But I think when things blow up, when things go wrong, or if you see accounting practice changes that are more aggressive, or they move from aggressive to conservative, or there's just, you can sort of see, you just hope that there's been some good discipline in the companies to review those relationships and really look independently at them to make sure that incremental risk doesn't just build up over time and suddenly become a big issue. I think that's an interesting one which we'll watch in New Zealand.
And as much as we are a small market, we do have more than one audit firm. So there's
we
still
do,
the opportunity to move.
And our audit firms also have very long arms into global expertise around the world.
Yeah, so it seems like a bit of a weak counter-argument to me.
I get it. It's expensive, and and New Zealand is small, but you're right. It's the risk of something going wrong well outweighs those
the cost of
yeah,
absolutely. Now those are data that are currently available. You look on annual reports, you'll see how long the auditor's been in place. If there was one new governance disclosure that you would be able to require for all public companies, what would it be?
I think the sort of place that I've got into, more recently in my thinking is the real intersection between, how a company is run and it's operating and all its financial metrics, along with the corporate governance metrics, and how they can come together to tell us more of a story rather than looking at these things in isolation. So, that's where I'd really like to drive my research into the future, is really understanding those connections and how they can support or negate each other and what signals we get from it.
Is there are there any particular data items that you'd love to be able to go to the NZX 50 or the NZX listed companies and say, I'd like these data please to be able to do my research? And
oh gosh, I think one thing that I would like to see, and I'd like actually the industry to come together on this, is to really review and consider whether the corporate governance metrics that are the best practice corporate governance metrics that are in place today are still fit for purpose for the future. As far as I know, good corporate governance practice hasn't really changed over, 30 years or so. Sure, it's tweaked around the edges here and there. There's better definitions, and NZX is always trying to define things differently. Last year it was more about the independence of a board. Independence, what does that mean? But we are operating now since COVID. The economy is in quite a different situation, and whether it's hybrid working, whether it's climate change and disclosures coming in, whether it's AI, it's a different economy, not to mention different interest rate environment, all of those sorts of things. The way we operate is different to how it was before COVID, and I think it would be a really great thing for the industry to come together and just reflect on what good corporate governance practice is now, and if it's still fit for purpose and going forward.
Yeah, great, thank you. One final question for you. In your role with your expertise, if you were able to give one piece of advice to all New Zealand boards, that some of them may not need the advice, but the majority of them would, what would be the one piece of advice you would give to all New Zealand boards?
I'd probably really like to see a more constructive relationship with shareholders, and I know that's hard, so we do a lot of guessing. We don't sit around the board tables, but we pick up a lot of signals. To be a fly on the wall sometimes, but in a board discussion. But a really sort of open, sharing, trusted relationship with shareholders, I think would go a long way to helping us really understand how effective a board is being. And I think that's kind of an area which I keep coming back to, is how do we really assess board effectiveness when we're not at the table? And one of the things in the recent research that I did was, a couple of the companies that we wrote about that have performed really terribly over the last couple of years from a investment performance perspective. We looked at 5 of them. 3 of the 5 didn't do self-reviews the boards didn't do self-reviews, and I think it's an interesting one, and I'd love to see boards do more of that, and I'd love them to share the findings with shareholders, what they think is going well, and what they think their headwinds are, and then their plans in place to address them. And I think that would really help the conversation between boards and shareholders to build trust and understand where things are at.
Yeah, great. So boards, please, stronger disclosure to shareholders and more relevant disclosure about what's happening and their functionality. Yeah, great. Katie, again, thank you very much for your time.
Thank
really
you.
Appreciate it. Been a great conversation.
Yes.
Look forward to catching up again soon and maybe talking about your research.
Thanks, Mark.
See you next episode. Thank you for watching this episode of Governance Bites. We have more episodes on YouTube and your favourite podcast channel, where I interview directors and experts on various topics relating to boards of directors and governance. We'd love to see you back, and please like, subscribe, and share the videos and podcasts.